Investing is often misunderstood as something only wealthy people can do. But in reality, it is one of the most accessible financial tools available today. You don't need thousands of dollars or a finance degree to begin. In fact, starting with just $10 can be the most powerful step you take toward financial growth. Investing is about building habits, not just building wealth. It's about learning how money works, how it grows, and how you can make it work for you instead of always working for money. Many people delay investing because they think the amount is too small to matter. But the truth is, the habit of investing matters far more than the amount you begin with. Today, we will talk about Beginner's Guide to Investing. Start with just $10. So, before we start, make sure to hit the like button and subscribe to my channel. Investing simply means putting your money into something with the expectation that it will grow over time. Instead of keeping your money idle in a savings account, investing allows your money to earn returns. These returns can come in the form of price appreciation, dividends, or interest. The reason investing matters is because of inflation. Over time, the cost of living increases and money loses its purchasing power. If your money is not growing, it is effectively shrinking in value. Investing helps you stay ahead of inflation and build long-term financial security. Starting with $10 may seem insignificant, but it plays a crucial role in developing consistency and discipline. The biggest barrier to investing is not money, but mindset. When you start small, you remove the fear of loss and make it easier to take action. Small investments also allow you to learn without risking large amounts. Over time, these small investments add up, especially when combined with regular contributions. The key is not how much you invest initially, but how consistently you continue investing. Compounding is often referred to as the eighth wonder of the world because of its ability to grow money exponentially over time. When you invest, you earn returns on your initial amount. Then those returns start earning returns as well. This creates a snowball effect where your money grows faster as time passes. Even small investments can grow into large amounts if given enough time. This is why starting early is more important than starting with a large amount. There are several types of investments available, and understanding them is important before you begin. Stocks represent ownership in a company and offer high growth potential, but they can be volatile. Bonds are considered safer and provide fixed returns, but their growth is slower. Mutual funds and ETFs allow you to invest in a collection of assets, making them less risky due to diversification. Real estate involves property investment, while cryptocurrency is a newer and highly volatile option. For beginners, diversified investments like index funds or ETFs are usually the best starting point. To begin investing, you need a platform or brokerage account. Many modern apps allow you to start investing with very small amounts, even as low as $10. Look for platforms that offer low fees, easy-to-use interfaces, and educational resources. Some platforms also allow fractional investing, meaning you can buy a small portion of expensive stocks instead of needing the full amount. This makes investing more accessible than ever before. Every investment comes with a level of risk. Generally, the higher the potential return, the higher the risk involved. Stocks can provide high returns but are subject to market fluctuations. Bonds are more stable but offer lower returns. The key to managing risk is diversification, which means spreading your investments across different assets. This reduces the impact of losses in any one area. As a beginner, you don't need a complex strategy. One of the most effective approaches is dollar-cost averaging, where you invest a fixed amount regularly regardless of market conditions. This helps reduce the impact of market volatility and removes the need to time the market. Another strategy is buy and hold, where you invest in quality assets and keep them for the long term. Both strategies are simple yet highly effective. Consistency is the foundation of successful investing. Investing small amounts regularly is far more effective than investing large amounts occasionally. When you make investing a habit, you build momentum over time. Even if you start with $10, increasing your contributions gradually can lead to significant growth. The key is to stay committed and not let short-term market changes discourage you. Many beginners make mistakes such as trying to time the market, following hype, or investing without understanding what they are buying. Emotional decisions often lead to losses. It's important to stay calm during market fluctuations and focus on long-term goals. Another common mistake is lack of diversification, which increases risk unnecessarily. Learning from these mistakes early can save you a lot of trouble later. Investing is not a quick way to make money. It requires patience and a long-term perspective. Markets go up and down, but over time, they tend to grow. Those who stay invested and remain patient are more likely to see positive results. Patience allows your investments to recover from downturns and benefit from compounding. Before you start investing, it's important to define your goals. Whether it's saving for retirement, buying a house, or building wealth, having clear goals gives your investments direction. It also helps you choose the right strategy and stay motivated during challenging times. Monitoring your investments is important, but it should be done in a balanced way. Checking too frequently can lead to unnecessary stress and impulsive decisions. Instead, review your portfolio periodically and make adjustments if needed. Rebalancing your investments ensures that your portfolio stays aligned with your goals. Starting with $10 is just the beginning. As your income grows, you should aim to increase your investment contributions. Even small increases can have a big impact over time. Reinvesting your returns further accelerates growth and helps you reach your financial goals faster. Markets are influenced by various factors such as economic conditions, interest rates, and global events. While it's good to have a basic understanding, trying to predict market movements is extremely difficult. Instead, focus on long-term investing and avoid reacting to short-term changes. The more you learn about investing, the better your decisions will be. There are countless resources available, including books, articles, and videos. Continuous learning helps you stay informed and confident in your investment journey. One of the biggest advantages of investing is the ability to generate passive income. This can come from dividends, interest, or rental income. Passive income provides financial stability and can eventually reduce your reliance on active work. Investing can sometimes feel slow, especially in the beginning. It's important to stay motivated and remember your goals. Celebrate small milestones and focus on long-term progress. Consistency and patience will always outperform short-term efforts. Starting your investment journey with just $10 may not seem like a big deal, but it is one of the most important financial decisions you can make. It marks the beginning of a habit that can transform your financial future. Investing is not about timing the market or having a large amount of money. It is about starting early, staying consistent, and allowing time to work in your favor. Every small step you take today builds the foundation for a more secure and prosperous future. If you liked this video and would like to see more like it, celebrate small milestones and focus on long-term progress. Consistency and patience